4.5% as we expected. Interest rates now the highest since 2008. I think the technical wizards at GB News have already put those numbers into a graphic which we can look at. And if you look at this graphic, you can see that during the years before lockdown, interest rates were already historically pretty low, less than 1%. That was a hangover from the global financial crisis, of course, back in 2008-9. They went down to just 1/4% during those years of lockdown. But look at that escalator increase to the right of that graph. 12 successive interest rate rises in little more than a year. Well, from December 2021 to May 2023, 12 in a row, from 0.1% to 4.25%. That's why the housing market is very, very shaky. That's why financial markets are shaky, of course, because a lot of banks we've seen in America, but also here in Europe and the UK, are suffering with those higher interest rates because they bought lots of government bonds, the value of which falls when interest rates rise. So this is a very difficult financial situation, and there will now be pushback from financial markets. They will be saying to the Bank of England, look, do you really need to raise rates anymore? You're going to end up crashing financial markets. You're going to end up killing the UK's fragile recovery, because monetary policy, interest rate rises, is a very blunt instrument, Mark. It's basically trying to make households and firms poorer, make it more expensive for them to borrow, reining in their horns, if you like, in order to crush demand in the economy and keep a lid on price rises. It's a very blunt instrument, particularly when so many of the price rises are for supply-side reasons, ongoing supply chain issues, and many people will say profiteering from some of the food retailers, the energy companies. They will, of course, deny that, but I think a lot of quite respected economists are now eyeing different parts of the economy, wondering why inflation here in the UK remains so stubbornly high.
And just looking at this graphic again, I mean, a lot of people have been questioning the approach. We've had what they call an incremental approach of these 0.25% rises coming in on a regular basis. I mean, there's some people saying, why didn't they just try and shock the economy by going for a big 1% rise to see if that would choke off inflation? Would that have worked?
I think it would, yes, Mark. I've been arguing that for several years now, that the Bank of England should have been raising rates much faster, much earlier. In the US, that's what they did, and US inflation is now down below 5%, though that's partly linked to cheaper energy prices in America, as I've been saying. Look, it doesn't surprise any GB News viewers or listeners or anyone in the media. I've been very critical of the Bank of England. I think there's far too much groupthink on the Monetary Policy Committee. There aren't the kind of intellectual outliers who have the credibility and the experience and the financial markets smarts to argue against the conventional wisdom. The Bank of England, in my view, has been, it was myopic about inflationary dangers in 2020 and 2021, which many of us were warning about. When it finally accepted it needed to make a move on interest rates, rather than bold, decisive, broad brush actions to convince the markets and people in the economy that they were going to squeeze inflation out of the system, we've had grudging, slow, incremental interest rate rises. And that's why, in my view, we'll never know the counterfactual, but in my view, that's why interest rates in the UK have had to go up further than they otherwise would have had.
Well, Leo, a bit of thinking from inside the Monetary Policy Committee coming through now. Let's just update people. The fact that 7 members of the committee voted to raise to 4.5% from 4.25%. The remaining 2 members wanted to keep rates unchanged, saying inflation already expected to fall considerably this year without the need to raise the rate again, saying a lot of the impact of rising rates had not yet come through into the economy. The bank itself estimating around a third of the impact of rates increases have been passed through. So there is still uncertainty on that committee. I mean, only 2 of them, but seemingly, they're still not certain as to whether this is too much.
Look, economics is not a science, Mark. It's a rather grubby and deeply politicised art. Take it from me. There are always going to be differences of opinion. That's what economics is about. No one can predict the future, and if they say they can, then they're not being truthful. It's good that there are variations in views on the Monetary Policy Committee. And even though I've been quite, what we say, hawkish on inflation, looking for early interest rate rises, I actually wrote a column a month ago saying that I don't think the Bank of England should raise interest rates anymore, because we've already had 11, now 12 interest rate rises, they take months and months to feed through the system. The famous monetary economist Milton Friedman always said, he won the Nobel Prize for it, that monetary policy works with long and variable lags. Given that inflation is likely to fall sharply in the coming months, it may be that this latest interest rate decision looks, as if the Bank of England has now overshot in the other direction. But look, no one's saying monetary policy is easy. The people in the building behind me do have a tough job. I think there should be a broader range of opinions on the Monetary Policy Committee, and I've said that for a long time. And also, no one is saying that these interest rate rises are easy at all. If you've got a mortgage, if you're a business with debt, this will slow the economy down. And the danger is if the Bank of England does yet another interest rate rise in the months to come, then they will crush the UK's fragile economic recovery.
Indeed. Liam, thank you for that. But let's just take everyone through a bit more of the bank's thinking. It's just released some of its thinking in terms of the report, with the increase in the cost of living expected to fall slower than previously thought, says the bank, a warning effectively. And the government's promise to halve inflation by the end of the year, narrowly on track. That's the phrase they've used. Now, the bank says it expects the consumer price index, that's the inflation figure effectively, to be at 5.1% by the end of this year. And the government, of course, wanted the target of bringing inflation below 5.35%. That was the promise from Rishi Sunak. So it might just achieve that. But it is this monthly increase in food prices, says the bank, that has slowed things down. On the other aspect, though, economists at the bank think that there will be a better position in terms of growth in the economy. The bank saying now it expects GDP, gross domestic product, or the growth in the economy, at 2.25%, higher at the end of its three-year forecast than it said in February. Indeed, the largest upgrade since 1997, when the committee was actually formed. So this is quite significant. They think actually that growth in the economy is really going to pick up, something that Liam has been talking about in terms of the green shoots of the economy. However, let's also reflect that the Citizens Advice Bureau has said that for many people, life is getting worse, not better.